At MDP, he's doing his diligence on this thing, and I think he wants you to take a look. I think he wants you to take a look, and I'm happy that he's working so hard. He's what is this again? What company is that?
Focuses on Meredith Corp is an American media company that focuses on publications and marketing services around the home, family, food, and lifestyle markets. National media and local media. Rachel Ray, Better Homes and Gardens, Family Fun. Okay.
Can we do it?
They own 15 television stations.
He's saying PE is low due to an acquisition, but the price of free cash flow.
Well, first off, PE is not affected by acquisitions. Acquisitions do not hit the bottom line. Acquisitions are a balance sheet and cash flow statement transaction. They do not appear on the income statement. And in fact, this company does not make money in the last 12 months. They've actually lost money in the last 12 months. There could be a lot of reasons for that. Last quarter, they made money, but they currently do not even have a PE over the last 12 months. So remember, guys, I hear this all the time. Acquisitions are not, you don't, when you calculate free cash flow.
Oh, I'm sorry. He didn't say PE. He said net income. I'm sorry. Net income is low.
So net income, that's again, same thing. Essentially, net income is the bottom, is the E in PE. That's not affected by acquisitions. Now, the only thing it could affect is if there are charges taken to the acquisitions that are amortized, the portion of them are taken out in net income at a certain time, but that would be an ongoing expense thing. So that is a very good comment to make. I'm glad you made it. But when people, the most common comment I get in the section is, well, Paul, their free cash flow is low because of an acquisition. Free cash flow is before the acquisition. You calculate cash from operations less your capital expenditures, and then the next line is subtracting out acquisitions and dispositions. So we'll still look at this, but there is a negative to PE right now.
Okay, so two straight checks off the bat. Let's look at revenue.
No.
I'm sorry. X's, of course.
X there. Margin is X, even if we have it. They used to pay a 10% dividend. That is bye-bye. That has gone away. So we have two X's. It's about $1 billion company.
Okay, and this is MDP, $1 billion. Revenue growth over the past 5 years?
They do have revenue growth, 1.24 to 2.75. Check mark there. Some big jumps here, guys. Was there acquisitions here? So here's what I'm going to do now. I'm going to look at their cash flow statement and see if an acquisition was done here, because that is a big jump. So I'm going to skip right to acquisitions where I can show you guys right here. There it is.
What is this?
This is the cash flow statement, the investing section of the cash flow statement. Net divestitures and acquisitions. Acquisitions are a negative number. 2 years ago, they spent $2.8 billion buying a company. That is why their revenue jumped up so much. So this is how you tell the story after looking at the 8 pillars. You tell the story, you get the answers, and you find out what they bought. Okay? They make acquisitions pretty much every year. There's a lot of negative numbers here. This is a positive number right here.
Right?
What?
You like acquisitions, right?
Listen, it's like saying,
I know.
You like clothes, right? It's like, well, we're not going to wear a evening gown to work, you know what I mean?
But you would at 100,000 subscribers wear an evening gown for a whole show, wouldn't you?
Probably would.
By the way, folks, for the patrons out there, I am going to jump on more often. I want to do a little live stream with you to learn from you guys some more ideas, maybe a little more connecting between you and I. I want to get more ideas from you and zany bits that we want to do. Paul and I are totally for zany bits. Paul has offered tens of thousands of dollars to people to cut their own fingers off. I'm not kidding. To do zany...
Mason's brother agreed to it and then backed out at the last second.
So, like, if we have ideas, maybe not so much now, but we're going to talk about some zany bits, including, I think at the million subscriber mark, I will get tattooed on my butt cheek, Paul's face, and other zany stuff. So we're open to ideas. If you queue it up, we very well might do it. Anyway, I get back to Paul. Let's get back to MDP. We are looking at profit growth. We just looked at revenue.
So
Go ahead, Mo.
One second. In 2018, Time Inc., that's who they bought. They bought Time Inc.
Oh, they bought Time Inc.
for $2.8 billion, and that closed on January 31st of 18.
Wow, Time Inc., huh?
Yep.
These are the guys who picked Time Magazine's. I remember Time Magazine's Person of the Year in 2004 or 5 was you.
Isn't that nice?
Oh
no, it's the stupidest thing I've ever heard in my entire life. I lost all respect for Time Magazine Man of the Year,
that sounds like
Person of the Year when they did you.
Again.
Like, you brought us YouTube, you brought us this, you brought us... Like, shut up, you losers. All right.
Oh, you're so positive, Paul.
$34 million in profit, negative $234 million. X. They lost a lot of money in the last year. That was the pandemic time. It is what it is.
How about shares outstanding, pillar number 5?
Well, good news there. Not. 44.6 to 45.7x.
That was like Borat. Current assets over current liabilities.
Let's see if these guys like having cash on hand. $1 billion in cash, $750 million in current liabilities. Well done. Got a lot of debt too. $5 billion in debt in the publishing business. I have to understand that one. Now, free cash flow over the last 5 years.
Number 7, yes.
Okay, ready? 200 million. Make sure I did that right. I did. And 250 million. Check mark.
Okay.
So look at it. Last year, they had a negative on PE with free cash flow of 250. They lost 234. They might have had some write-offs or something. So that's why we don't always look at just PE. Do you see what I'm saying?
Go on.
There was free cash flow last year, even though the profit in the company, the net income was negative. There might have been a write-off. There might have been an acquisition they did years ago they wrote off completely, or several acquisitions. That's what you have to understand.
Go on.
So the average. Ready, Seth?
I'm ready.
184, 97, 200.
The average free cash flow over the past 5 years is 186 million.
Okay, I'm not a huge fan of this. So here's the deal, guys. This is where we talk about the multiple. You got to decide how much multiple, how much room you want in. I will say this: the company's currently what, $1 billion?
Yeah, 1 billion is the market cap.
Wow, it's selling for 5 times free cash flow. So look, 981 is the current market cap divided by 186. What's that equal? 5? Or a little bit over 5?
If you're asking me, I wasn't paying attention.
Call it 5 just to be safe, just to be low. It's 5. I mean, that screams there's something you want to do. I mean, that's pretty low. So I do give them credit for finding a very low free cash flow business. Let's see how very low multiple of free cash flow. Even last year, they did $350 million in free cash flow last year. Okay, here's what I'm going to say about this company. I'm intrigued. Here are the things you need to look at. Why is the free cash flow and the net income so different? Find out why that is. Because I like those kind of businesses, because usually what happens is they'll have a big write-off. Everybody will freak out because they'll see the net income number. That's all people look at. And they'll say, this company's going to hell, this thing sucks, move on. And then the free cash flow is still there. I still remember one of the best investors I ever said, when he showed me a company once, the first thing I said was, oh, look at the PE. He goes, don't look at the PE, look at the free cash flow. I said, oh, and I looked at free cash flow. I'm like, holy cow. It was like 7 times free cash flow. Why? Because everybody was focused too much on their recent write-off. They had a big write-off in the last year, and everybody's focused on that, as opposed to they had a write-off. And if the write-off happens every single year, you should factor it in. But if it's once every 10 or 15, 20 years because they made a mistake, they're impairing their charges, Seth is giggling, I don't know why, then I think this is something to look at.